Home prices are going to crash in 2023. Home prices are going to keep rising in 2023. As you can see, depending on what you're reading, there's a lot of different opinions on what's in store for us next year. And the point of this video is to cover three things. One, reasons for and against why home prices might decrease. Two, to give you my personal opinion on what's going to happen next year. And three, to give you some perspective regardless of what happens so that you can have a little bit of peace of mind. Kicking it off, let's talk about some reasons why home prices may or may not decrease. And I think the elephant in the room, what might actually happen, is that the US has been going into a slowing economy. Without going into a whole nother video in the nitty-gritty of it, the economy has been, regardless of what the government wants to define it as, in a recessionary environment, and the consensus is moving into 2023 that we will continue to have those recessionary factors. The other thing that we want to think about is US household savings. This is something that the economy has kind of touted for the past few years, is that the US consumer has had lots of savings and net worth. But with a decreasing stock market, as well as inflation kind of wearing away at savings, we're starting to see that's not the case anymore, and that's going to impact the stability as well as financial position of US consumers out there. The other thing that kind of goes hand in hand with that, the factor when you're looking at the metric around credit card debt. And this one's a little bit scary when you're reading into it, in the sense that US credit card debt is at some of the highest it's ever been on record. That is something that we've been tracking, and when you look at consumers putting more and more on debt, that has to get paid back at some point. And when you think back to the previous point, with savings being lower, there's kind of this disparity between how much money they have versus how much money they're spending. And you never want to have a consumer that's too debt-ridden, and that puts them in a more of a financially constrained position. The other factor, which I think everyone's heard of at this point, and a lot of my clients talk to me about, is interest rates. There's no doubt that at the beginning of the year to now, interest rates have risen at a pretty steep factor, even though they're at historical norms. But whenever that happens, it means mortgage payments are higher and purchasing power is lower, which ultimately means the buyer pool is getting smaller. One silver lining, though, is that as of late 2022, we've started to see a slight decrease in interest rates. So that may be actually something that's alleviating a little and can actually help us out, and may be a preventative for why prices might decrease. And the last one, which I'm calling an X factor for why prices might decrease, is all around unemployment. Right now, the US has done a really good job of getting unemployment down since COVID, but one of the factors that you're starting to see headlines around, and that could drastically change the marketplace, is if unemployment rises at a steep rate. Once you have people who have a certain mortgage payment or household debt and they're able to pay it with their job, things are stable. But if unemployment rises, that's going to drastically change what households are doing and what they can afford. And that's when you really start to see a scenario where home prices could actually take a hit. But on the other side, since that hasn't happened and may not guaranteed happen, that is kind of the X factor. But there are some things that are leading us to believe home prices may not decrease, or at least won't crash. The first one being equity in homes. A lot of times when you hear about a crashing real estate market, you're hearing about a lot of foreclosures and people who have to get out of their house because they're underwater. A lot of people who have had houses for the past year plus have built some equity into their home. So if there was a scenario where they needed to sell it, I think there's some comfort in the fact that they would be able to sell their house and still have some money that they're walking away with, which kind of gives a floor for that situation where you'd have a crash, because they could get out without having to have those worst case scenarios. The other one, which has been probably the most intrinsic part of the real estate market for a while, is low inventory levels. And going into this part of this season, as well as next year, we are still at super low historical levels for inventory, and housing building hasn't been at a level that's really going to address that factor anytime soon. So whenever you have that basic supply and demand relationship where supply is low and demand is at least stable, I don't think you're going to see a situation where things are dropping very quickly. The other one, which I think gives a lot of people comfort from the 2008 scenario we were in, is that the better loan products we've had given over the past few years. Back in 2008, really terrible loans were given out, where situations where people had bought their house and didn't understand the loan they had, and then had fluctuating payments with adjustable mortgage rates and things like that. But we've had a lot more stability in the loan products that were given. They were evaluating buyers and making sure they were getting better interest rates, as well as having fixed rate mortgages. So there's a little bit more stability around that market, and that's going to really decrease the chances of someone having to get out because they completely can't afford their house. And the last one, which almost seems contrary to why it might help, is inflation. Even though it's caused some of the factors that are on the other side of the economic kind of situation we're in, historically, real estate has been a hedge against inflation. So even if it's not transitory like the Fed initially said, and we continue to have inflation in this market, real estate should kind of hold its value and increase in an inflationary period. So if nothing else, that's actually weighing on both sides of the factor for why it may and may not go down. But regardless, these are things that you can really be tracking against. And at the end of the day, depending on what happens with each of those independently and as a whole, that'll really guide where prices go next year. Okay, so the second thing is my personal opinion, and I'll give the asterisk. This is 100% my opinion based on things I've been studying and reading and kind of seeing in the marketplace, but everyone should be making their own educated guess on what they think is going to happen, because that's how you make decisions. So bottom line up front, I'm actually calling for a 2 to 5% decrease in real estate prices nationally. Now, more importantly than that is the factor that real estate has always and will continue to always be a local marketplace activity. So what that means is, yes, as a whole, I think home prices are going to decrease, but the area you live in is far more important, because things could be worse than that 2 to 5% scenario, or they could be better. And that's going to be largely dictated by the jobs in your area as well as the activity that's going on. For instance, I live in Northern Virginia, so I actually have a different forecast for Northern Virginia, where I'm calling from anywhere from a -1% decrease all the way up to a 3% increase, because we have a lot more stability from the government as well as the types of jobs in this area. So again, knowing where you live and identifying where the economy is in that specific place is going to really be more important than a national average that you're probably going to see in a lot of the headlines. So if you have any questions about Northern Virginia or where you might live, you can always reach out to me and I can give you my personal opinion there. And lastly, I wanted to give some perspective, because without a doubt, going into this next year, there are going to continue to be those headlines that are out there for clicks and may not even be giving you factual information. They just want you to click onto their headline. So having things that I call principles, which are actually intrinsic regardless of what's going on, can sometimes give you comfort in times of uncertainty. So the first one I always tell people is pay attention to what's happening in the marketplace. You don't need to be a market expert, but you should be paying attention to see what's happened. For instance, we're not in the economy and real estate market we were in early 2022. So you're going to actually go to market and pursue a house differently now than you would then. And that's something that your real estate agent, but you as well, should be kind of at least in tune with, just to understand what's going on and to react accordingly. I think is a principle that everyone should be following, is to live within your means. And what that means is, going into this next year, if there are going to be tighter economic conditions, you're going to want to make sure that you're taking the time to really understand your financial position and react accordingly. That doesn't mean you can't buy a house in 2023, and it doesn't mean you can't go on a vacation in 2023, but you should really understand where you're at and have a understanding of what you want to have, from a mortgage payment all the way to reserves and spending, so that you can make a good decision there. And the last thing that I think will give everyone comfort is tied around real estate prices historically. Regardless of 2023, that's just going to be a snippet in time, and a lot of people are going to focus on it, but real estate should be a longer term investment for people. So the consensus has been, and I feel fairly confident in this moving forward, is that home prices will continue to increase over time. So if you're purchasing now, who knows, maybe you're getting your house on a discount or on sale, since home prices are not increasing at the rate they have been. But if you're staying in there over a long period of time, you're still going to earn that equity over time, and you're going to build wealth, which I think is one of the major factors for buying a house, in addition to many other things. So hope you found this helpful. Hope it gives you some perspectives and some things to look out for going into the next year. You can always leave a comment or send me a message if you have a different opinion on what you think might happen, because I love talking about this stuff. So until the next video comes out, thanks so much for watching and have a good one.